Scotiabank has started to slow its mortgage business. Could this be an indication of credit tightening? So let's get right into this and see exactly what is going on. So this article comes from Canadian Mortgage Trends. Scotiabank continues to slow its mortgage business in favor of multi-product clients. Scotiabank continued to deliberately slow its mortgage lending in the third quarter amid heightened economic risk and part of its plan to be more selective with onboarding new clients. Now, what part of that does not say credit tightening, right? They are essentially highlighting the economic risks. You know, we've had the GDP report that was just absolutely awful. If you believe the CPI is higher than the CPI that we see the government reporting, then you know we are in the depths of a recession right now. So this is probably a prudent thing to do. And you have to remember as well that Scotiabank is one of these banks that is more exposed to emerging markets, and it's more exposed to China than the other banks. Bank of Montreal is the other one that is exposed to China, and we don't know how much it is exposed to the China real estate market and the Chinese economy overall, because it's not just the real estate market, it's the Chinese economy which is imploding. So it's kind of interesting. Let's continue to see what they say here. The bank's Canadian residential mortgage portfolio fell to $294 billion as of the third quarter, down from $300 billion in Q2. So it shrank by $6 billion, not a lot, but it is shrinking, and they even highlight exactly why they're doing that. So I think this is key, and it's really just the start, and it's really just the first bank that is doing this. I think there's going to be more and more of this coming, and this is what people don't understand and don't see in Canada. To really get a housing market crash, which we've talked about on this channel many times, you need credit tightening and you need high unemployment. And could this be the start of the credit tightening? Well, it certainly is in the case of Scotiabank, but we'll see with the other banks. So the bank announced earlier this year that it would intentionally slow its mortgage book and put a greater emphasis on growing deposits to lower its reliance on wholesale funding from large investors. So it's interesting, and then it shows the maturity schedule at Scotiabank, so you can effectively see where most of their mortgages are renewed, which is very interesting. You can also see that their net income is down 15% year over year. So think about that with what we discussed last week when we did that video about how the Bank of Canada is stealing from you. You've got these banks that are earning considerably higher amounts from the Bank of Canada for just parking reserves, and essentially, you know, they've got their income that has dropped 15%. So their income should be way higher, but it's not. So there's something definitely going on there. Obviously, we've got the commercial real estate. We've got the fact that they're exposed to emerging markets. They're not doing particularly well, particularly Mexico. You know, they're exposed to Mexico. Obviously, Scotiabank is pretty big in Mexico. God knows how much they've got involved in the real estate lending for Airbnb, because Mexicans have really jumped on that, and there's a big risk there that I've talked about as well. So it's incredibly interesting what's going on. I mean, what do you expect really when you've got, you know, household debt to income at this insane level? Household debt to income in Canada, second highest in the world right now. Just crazy when you think about it. You've got the mortgage debt. We've been through this chart. It's not even up to date. So this has actually gone way higher than even this chart. But you can see it's gone way above $2 trillion in Canada. So the amount of mortgage debt that you have is just unbelievable. And if we flick over to Hilliard's chart, which I really like because this shows you something which you don't see often on charts, is you can see obviously the CPI, which is this line down here. It's this blue line, the dark blue line. And then you've also got the median after tax income that is this line here. And just look how flat that has been since 2016. It's pretty much been very flat. Obviously, we know it's very negative. I've been through it many times on this channel. I'll link a video at the end of this if you haven't seen it, how the wages are way more negative than the actual data even suggests, because the CPI is completely not accurate at all, as you guys know. So unless you actually believe the CPI, then guess what? Real wage growth has actually been way more negative than people even understand. So that line on this chart has likely actually come down. Meanwhile, you've seen home prices that have just shot up. And you can see how they just completely decouple with reality. And, they tried to correct in 2008, 2009. They came in, tried to prop up the market. The market wasn't as levered as it was in the US, so that allowed Canada to continue onwards. But now we're seeing the complete reverse of that. Whereas the Canadian market is way more levered than the United States was during the peak of the financial crisis. So the tables have completely flipped around. It's kind of crazy. And then you've also got this, Scotiabank and BMO brace for a spike in bad loans. Isn't it funny that the two banks that are talking about this are in fact the banks that are in China, BMO and Scotiabank? Third quarter earnings show Scotiabank and BMO have respectively doubled and tripled the amount set aside for bad loans compared to the same quarter last year. Now, this is being told in the perspective of the mainstream media in the sense that, oh yeah, the banks, they're doing all these different things to essentially mean that our banking system is stable here, and we'll get into how laughable some of these things are as well. So BMO's provision for credit losses totaled $392 million, up from $136 million in its third quarter last year. So that sounds fantastic, doesn't it? To the average Joe who is reading this story, they're going to think, wow, they're really increasing the amount of loan loss provisions that they have. That's really good. That makes me feel good about what's going on with the bank. But they have like nearly $1 trillion in loans, BMO. So, having that amount, whatever it was, $492 million, that is a drop in the ocean in terms of covering bad loans. So they're coming out and they're saying, yeah, we're increasing our loan loss provisions. The regulators are looking at us and they're saying, hey, you guys, you need to do something. There's all these negative amortization loans. You've got all these people essentially in distress. You guys need to do something. And they're just like, okay, we'll put them up. It's just virtue signaling. It's virtue signaling by the regulators and the banks who are in bed with each other. The regulators are ran by the banks, the OSFI. It's so crazy and it's so corrupt. It's so incestuous as well, the banking industry. It's unbelievable. Scotiabank's provision for credit losses totaled $890 million in the latest quarter, up from $412 million in the same quarter last year. Again, you look at that and you think, oh, okay, yeah, they've doubled it. Wow, they're doing a real good job. So you think, you're like, oh yeah, this is good. That gives me a lot of confidence in the banking system. But what you don't realize is the amount of loans that they have outstanding. And the Toronto Star is, of course, never going to tell you that, right? That's the thing that they leave out. A crucial piece of information is the percentage of how much of their loans that actually is that they have for those credit loss provisions. And it's not even 1%, guys. That is how just crazy that is. So let's see what else that they're saying. The increase in credit loan provisions, I think they mean credit loss provisions, comes just after 2 months after the federal regulator, the Office of Superintendent of Financial Institutions, ordered banks to set aside billions more in rainy day funds to prepare for defaults. They're talking about setting aside billions for defaults, but they've only set aside hundreds of millions. That's not enough. And especially when you're talking about hundreds of billions in loans, if not trillions in loans. So this is just a drop in the ocean. It's all virtue signaling by the regulators and the banking system, in my opinion. This is just to keep people thinking that the banking system is secure and it's stable. And we know it's far from those things. I mean, you've got banks like RBC, like we discussed last week, who are laying people off right now. Yeah, everything is totally fine in the financial system. You got like 48% of the loans right now. The loan balances are increasing. Amortizations are being pushed out, which means the probability of the person paying back that loan is going way down. The value of that mortgage is collapsing. It's cratering because the risk of default is shooting higher. Meanwhile, the yield should skyrocket. But the thing is the yield going to skyrocket when that person eventually defaults? So it's just, there's a huge amount of risk in the financial system. then you layer on that commercial real estate, you layer on the top of that the China risk as well. There is just so many risks in this financial system right now. It is far from stable, but that is what the mainstream media wants you to believe with this article, that everything is rosy. Reaching their limit on loan flexibility. If you're a bank and you're seeing that unemployment is up, interest rates are up, debt is up, and insolvencies are up, it's kind of obvious they'd be writing off more loans in the future. But in some areas, they're not even tightening credit. I mean, you've literally got a prime example of this is Calgary right now. So you've literally got people who are moving to Calgary, and providing that they provide a good credit score and they have consistent employment, the banks are just going to lend to them straight away to buy a house. They're going to give the same rate to that person as somebody who's lived here for the past 10 years with the same employer for the past 5. Me and you, we look at this and think, hold on, the risk is way higher, that we know that that person from BC and Ontario is likely to default, could walk away, could lose their job. That the risk of that happening to them is much, much higher, but they're not actually pricing in that risk. So it just kind of shows that, again, the lending standards continue to drop during this housing bubble. So it is just insane, but people are oblivious to that, but it is happening. And like I said, Calgary, Edmonton, they're prime examples of that. Banks have been flexible in many ways, said Stanford, referring to arrangements like extended repayment terms and negative amortization on mortgages. The fact that banks are taking on such large loan loss provisions shows that these forms of incremental flexibility are reaching their limit. But they're not taking on large loan loss provisions. That is the insane thing. They are not taking on massive amounts of loan loss provisions. That's the opposite of what they're doing. They're just virtue signaling by increasing it. Otherwise, they would be putting 5-10% of the loan book that they have in terms of loan loss provisions in case people default. We know from the global financial crisis in 2008 and the bust in the housing market in the US that default rates can get to 10-13%. You know that the Canadian housing market is way more levered up than the US one was in 2008. So you could easily see default rates 15%. And then what the hell are they going to do with their measly 0.3% in terms of loan loss provisions? It's just going to be absolutely nothing. The fact that they're standing there and saying, oh, yeah, this massive amount of loan loss provision, it's a good thing. They're looking at the economy. They're being very prudent, these banks, and they're just not. It's just absolutely crazy the way that they kind of structure these narratives around this, saying that everything is fine, you have nothing to worry about. So yeah, it's saying that they're reaching their limit, but what is that going to mean? It's essentially going to mean default. And it's like I said, when you're the country with the second highest debt to income ratio in the world, when you have credit market debt to income this high in the household sector, not just in the household sector though, but also with private businesses, what do you expect to happen? When you've got mortgage debt that's over $2 trillion, and you look at this chart and you can see that, the growth of this was relatively flat from 1995 all the way to pretty much 2003, 2004. And then this line just starts to go parabolic. And we saw, you can even see the mania on this chart was from 2020 to 2022, where it just went parabolic. And what a lot of people cannot explain as well is a lot of people say, well, population growth, housing prices are never going to go down. But the fact is, you can blow that argument away by just looking at one metric, which is wages. If people can't afford to pay their mortgage, then guess what? Home prices can crash. Guess what? You can see a massive amount of supply come online. Now, does that mean that there's people there to actually buy that supply? Maybe, but it's like I said, if there's actual credit tightening that happens, then the last people that the banks are going to want to lend to are these subprime immigrants that are coming over that are very, very junior in the country and have just got jobs and they're not well established at all. They are going to be the riskiest type of clientele. So the fact that population growth is kind of the main narrative is just kind of baffling, because yeah, we know it contributes towards this housing crisis. Of course it does. But I think it's far more the speculative component, things like Airbnb. The speculation on the future population growth instead of actually the population growth. It's more the speculation on the population growth that drives the bubble than anything else. And it just goes to show what is really happening here. And people are over leveraged. You've only got to look at debt. You know, the debt is insane. We're over $2 trillion, guys. So this ends badly for an economy where, you know, the dependence on housing is over 30%. That is insane. That is way more than the United States during the global financial crisis. So anyway, if you've enjoyed this video, you might like this video here. You might like this playlist that I picked out for you there. If you're looking for a VPN, go to expressvpn.com/market mania. I will see you in the next one, guys. Take care. Love you guys. Bye-bye.